Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to look at some information off Twitter. We'll look at TTF, natural gas. It's been pulling back. We'll take a look at the housing starts that were just released, give you my opinion there, do a little bit of housing, and work our way around some energy numbers as well. So again, if you want to follow me on Twitter, you can find me at finding_finance. Let me zoom in here a little bit more. Right here at finding_finance. And if you want to follow me and see what I'm doing for commodities and trading, you can sign up for the finding-value.com, the platinum membership. I did release a midweek update. You guys can see the companies that I like, what I'm doing. I also do question and answer sessions, and the question and answer session will be Sunday, 5 p.m. Mountain Standard Time, for everyone who's a platinum member. All right, let's dive in here and see what we've got. So we've got one here. I think this is an important one. It says, let us look at the European gas market. Why has TTF collapsed? Is Europe out of the woods? What matters for commodity price formations? What will matter in 2023? So if we click on this guy's thread, I'm going to walk through it with you. It says European gas prices, both TTF and NBP, have collapsed right into the start of the winter season, down from its peak of 338 megawatt hours, post Nord Stream 1 sabotage news, to now 63 megawatt hours. Mind you, though, TTF was 13 2 years ago, still up 370%. You can see the chart here. We had that triple kind of move here, and we had a large kind of an ending, I would say short-term ending move in the short term. I don't think it's necessarily done, and we'll go over that. And I think it could be premature. We'll see. So here it is. Why is TTF lower? Because nat gas can only be consumed or stored. If storage is 95% full and not consumed, mild weather, prices have to do the work to keep system balanced as commodities trade in present, unlike equities, bonds, which discount the future. So commodities basically trade and are probably trying to balance that storage. And the way that I think of this, and hopefully this analogy, makes it right for you. You can have a full tank of gas, but if you're driving across the country, that is your flow rate. A full tank of gas will not get you through the entire winter. So it highly depends on how that gas is used, the temperatures, and all of that, and how much subsidies they have. It all depends on all of those things. So we can have large storage, but it can be eaten up quite quickly given the weather, given the subsidies they have, given both of those things in combination. It says, and Europe has not yet begun to consume gas as it experiences an exceptionally mild October so far. This is the EU gas withdrawal. You can see it's very low, and you can see it spikes up during the winter months. So we're not quite there yet in terms of demand, and the supply right now is okay given the weather. So is the gas crisis over? Of course not. Europe needs to replace even more liquefied natural gas in 2023, which will get much harder. One way to verify that is by looking at the futures curve. It prices TTF at 140 megawatt hours come November 2022 and into April 2024. So they're pricing the gas much higher out in the future, saying, hey, look, we've got scarcity still. At least that's what they think in the markets. It says, for now, let's be grateful EU operators filled storages across Europe by saving 13% year-to-date, year-over-year, and helped by the weather gods, summer heat wave, mild winter start. It says, not just EU savings and weather helped, China too. 20% lower Chinese liquefied natural gas purchasing year-over-year matters a lot too, as it dragged Asian JKM prices lower into winter months, as Asia obviously competes for those same LNG spot barrels with Europe. Here's a visual how to think about the global LNG market. In general, US, Qatar, and Australia are the big three exporters, while EU, China, Japan, and South Korea are the big importers of the global liquefied natural gas market. Of course, Middle East and Nigeria and Angola matter too. You can kind of see all these, who's eaten up and who's exporting all the liquefied natural gas. So how can Europe balance its 2023 market? It will have to source approximately 210 billion cubic meters liquefied natural gas. That is 60 billion cubic meters greater than 2022, which is 60 billion cubic meters greater than 2021. Weather and the Groningen field spare cap, about 20 billion cubic meters, are only factors that can change this forecast meaningfully. So there's still going to be a shortage next year in natural gas. It says China freed up 13 to 15 billion cubic meters in 2022 for Europe to contract away in the LNG spot market. If they will re-engage, which we suspect, and continue LNG growth path to replace some coal use, prices, not politicians, God forbid, will have to do the work, like now, to clear the market. So there's going to be, I guess, countries fighting over the liquefied natural gas and what's out in the market. It says Europe was able to purchase 60% more LNG, mainly from the United States, 75% incremental volume. That is because U.S. contracts have destination flexibility. It means cargo owners were able to sell on the way to its original destination, say Japan, into Europe to make instant profit, which is nice. It says in 2021, U.S. operators had total export capacity of 141 billion cubic meters and ran it at capacity, never without risk. U.S. operators have incentive, lower Henry Hub prices, arbitrage, to increase such capacities. But infrastructure expansion takes time. So 2025 to 2026 is the time for more exports. This also means that Henry Hub pricing will exert upward pressure for this demand. So U.S. liquefied natural gas export capacity by project going straight on higher here. We see later on more being added after 2025. The return of the Freeport terminal in Q4 2022 helps, but will not move the dial in terms of exports that Europe needs. It adds 6 billion cubic meters incremental supply for Europe in 2023. We're looking for 60. So that's kind of a big shortfall. So far in 2022, cargo owners had a huge incentive to resell LNG at spot to EU if they could. They usually purchased LNG pre-2020 on a long-term contract paid 6 to 10 MMBTU. Such LNG could be sold for greater than $30 all year, at times at $75 in the spot market. And that's the big arbitrage between Henry Hub and Europe. What matters, however, is that Qatar does not have breakup clauses or destination flexibility. Redirecting Qatar cargoes require Asian buyers to return it to the Qataris at par. Why would they? They're not. So let's enjoy the fact for now that nat gas has to clear daily within its physical infrastructure, which is storage constrained. Real challenge, however, will be to pull enough LNG into Europe come 2023. For that, prices must do the work, which means prices are going to go up to do the work to get those, to get the liquefied natural gas where it needs to be. I thought that was a cool thread. Coming on back, the Fed has destroyed the housing market. The destruction can be seen in the red box below. This is the S&P Case-Shiller U.S. National Home Price Index. This is the turn that we've got where everyone's calling for this big crash. I don't think it will crash. I'm still not declaring victory over anything. And we'll look at the housing starts here right after this. So Fred housing starts, we'll yank that up real quick. We'll pull that into it. And in all honesty, guys, I don't think this is that bad of a number. We're at 1.44 million for new privately owned housing unit starts. And for as bad as everyone's been talking about the housing unit starts, this isn't a horrible number. July 2022, we got down to 1.377. So we pulled up to 1.5 million, a little bit above. Now we're still above average. Now we're at mortgage rates that are over 7%. And I know this could be lagged a little bit. So I'm not declaring victory by any means. We're going to let the data do the talking, but we're still above the average. We are still in an expansionary phase of real estate, as weird as that is, with 7% mortgage rates. So, and this could have been when it was 5 or 6% and how these things clear and when they start. I understand. They might be delayed a little bit, and we'll continue to watch the data. But all of the people who think that mortgage rates are just going to completely destroy the market, I think are wrong. They have been wrong. Because if that was the case, we should be down by, we should be down here at 900,000 or something like that. But we're not. We're holding steady. So that's something I'm very interested in. I want to see what this does over the next few months. I want to see what it does over next year in the strong portion of the real estate market. Right now, we're in the weak portion. This normally goes down in this time of year. June last year, we were at 1.664, and we ended October at 1.563. That was a pullback. This one could be accentuated with the interest rate hikes and all that stuff. So I'm curious to see what exactly happens. I'm remaining an open mind. I've got an open mind there. It says, talking from Javier Blas, U.S. has just 106 million barrels of diesel stockpiles. Last time inventories were that low was in mid-October in 1951. Inventory should be 30% higher this time of the year. Fed have another wave of energy-led inflation coming, ? And this is the diesel prices boom on short supplies. Refiner margins are 450% above the 20-year average. So what this is telling us is that we have a refining problem, a shortage of refining for diesel. And that's going to manifest itself here any second. Coming on down, it says energy stocks versus the S&P 500 ratio just poked its head out of a 14-year resistance. Commodities producers continue to look fundamentally cheap relative to financial assets. And they do. They've been holding up incredibly well. We've seen lots of strength in XOP, in OIH, some of those ETFs, and they're starting to outperform the S&P 500. So on down days of like today, we were on a down day of S&P 500, and we were up in the energy stocks. And energy's been outperforming the underlying commodity as well. So I'm going to pull that up real quick just to show you. I'm going to do XOP over the commodity. So XOP divided by crude oil, the futures pricing. And if we look at that, we're seeing a ton of strength here. I like this very much so. So there's our kind of downtrend line that we've broken. You can also look at this from the perspective, if we were to kind of zoom in a little bit, and let's get this guy out of here real quick, do auto. I don't like this big volatility here, but you can also draw a line across here that we're basically had some resistance coming up here, and we're breaking out to the upside. This looks ultra strong, ultra bullish. We've got a nice, good bullish engulfing here. So I think that energy stocks look absolutely insanely good. And if we were to do, XOP looks great to crude oil. Let's do uranium versus XOP, and I think uranium, RUNM, the ETF, the uranium ETF versus XOP, which is another ETF. This looks really interesting down here for uranium. So uranium, if you look at it and you think about it, XOP is about to dominate crude oil. It's going to go up at a faster pace, and URNM could go up at a faster pace than XOP. So that means URNM is a highly leveraged play to energy. Now, I have a diverse enough, portfolio myself where I include all of these. I'm not trying to say that URNM will 100% for a fact outperform, but I can tell you we've broken the downtrend, we're above support, and we're coming back and doing that retest move that looks very good for uranium in general. So that is one thing I am seeing. It says you can't BS your way out of this one. And here is crude with SPR and gasoline. We are still continuing to draw down our inventories. We're walking into an energy shortage here, a massive one, I think. And the energy shortage, if you were to kind of sum it up, the SPR releases are going to end. I think that's probably 1 million barrels a day. They are cutting it back right now. And then we're going to see production supply problems with Russia. We're pulling out the Western energy service companies, and I think their production is going to decline. We also have increased demand coming from China when they have reopened, which they've done, and we're seeing that demand come back. So with this declining inventory and SPR coming offline, we are going to eat through inventory incredibly fast. So that's what I'm expecting. I think we're going to see a big move in energy whenever these SPR releases end, and it could start at any second within 30 to 60 days. So that's what I see there, and I think there's a huge opportunity there. This right here is what basically is validating our XOP outperformance in relationship to crude oil. We're also seeing the outperformance of uranium against that. So I'm kind of looking at all these things and seeing where the best opportunities are. It says the Fed is going to be forced to end QT soon as a result of abysmal liquidity in the treasury markets. Gold would go parabolic. This is why gold should start to go higher, even with rising rates. And I do think that is in the back pocket. And another thing that to think of here is this liquidity that's in the market or illiquidity for Fed or for the bond market. The bond market has been incredibly volatile, and I think that liquidity is going to have to come in and something's going to happen there. We've already gotten stress cracks in the system in UK gilts. I think it's going to spread across the entire thing. So I think physical metals is something that you have, I don't know, something that I'm looking at, that I have to look at. And it's something that to protect yourself in case currencies start to go berserk. I think this person is probably very much right. And energy is the cause of the cracks. The cracks are occurring, and it's going to be felt, I think, in bond markets and currencies, and it will migrate or travel throughout the world. And since this is worldwide, I think that there are potential, like the physical is not there. And if everyone's going to start to run at it, I mean, it is not there. It's going to go parabolic. I completely agree. How high? I don't know. I mean, it's anyone's guess, but I think the energy markets are causing it. And I like this. If oil closes green today, I'm dumping an additional bajillion barrels from the SPR. There goes Biden at it. Here's U.UN, huge spike incoming. I know John's been pretty bullish on a lot of different things, but this one I completely agree with. The Sprott Physical Uranium Trust is putting in some really good candlesticks on the right-hand side in terms of these large green candlesticks and small selling pressure. This is the exact formation I see before a gigantic move. So I'm validating that with URNM versus XOP. We could see a massive move in uranium here, and I think that's really good. Here's another JC. Silver and gold inventory on the COMEX plunged again today, down 858,000 ounces and 98,000 ounces. Investors understand the tightness in crude, but what happens when they realize that the vaults are about to be depleted of precious metals? China, Russia, and India are loading up. And I think we should be doing, something similar to China, Russia, and India here. At least, that's not financial advice. You have to do what you think is right, but that's what I'm doing. That's what I'm doing. If you're looking for 10-to-1 returns, you must be using money that you can afford not to look at for a substantial period of time and be able to tolerate at least 50% loss of principal, at least temporarily. And again, I've posted my midweek update for Platinum members. Chop, gold, it's time. And here's kind of a cool little thing that this guy put from a charting perspective. He did this on a time interval. Basically, he took these ellipses and you can shrink and expand them. And he's just saying, if you were to put this at the bottom of gold here, this green line, and you put it at the kind of the bottom here, and then you put it at the bottom here, what we can see for declining gold prices is this ellipse that could potentially link up with the gold price, and then he overlaid the 10-year treasury yield on it. And we had a pretty big move with yields going higher back in the 1970s. I think something very similar is coming, and that's kind of what this ellipse type movement or half circle looks like. So I guess I should say it's an ellipse, circle ellipse, whichever it is. So that's looking good there. It says 7% mortgages and volumes are down. Okay, so 7% mortgages and volumes are down single digits, ? Best data in a decade. excluding 2021. Where are all my housing bears? If this is as bad as it gets, the whole sector should roar on the pause. And he means about the pause of interest rates. If there's a pause in interest rates, Cuppy and I would say myself is probably going to see a buying spree in housing. That is yet to be seen. It's yet to be determined. It's yet to be, if there's a pause. I think the macro environment is really difficult to nail down as things are moving and are very fluid in the markets. So I'm not saying that the pause is here, but 7% mortgages could only bring housing starts down 8%. Housing starts fell 8% in September, and it's still above the average. And as weird as that sounds, I mean, a lot of people are saying, oh, this is going to crash, housing crash, housing crash. It hasn't crashed yet. I'm not saying that it can't crash. I'm not saying it won't crash. I'm just saying it hasn't crashed yet, and it's been very resilient in the face of very large mortgage rate increases. And I know people are going to show me data, but housing starts is really, it's the volume of housing starts that gets you that loan growth. Here's the S&P, one for the bears and the skeptics. This is the S&P 500 10-year rate of change cycle. That the 10-year rate of change is more or less the real estate cycle. And it's the real estate cycle whipping this stuff back and forth. What we've got here is an inflationary period showing that the S&P 500 is going to come back down. Probably next trough is 227, 2037. And on this cycle here. But I mean, that's what I see there for that one. Checkable deposits, still lots of money out there. This thing is just rocketing higher. I think I covered that already. So that's what I've got for today, guys. And the thing is, I'm ultra bullish on physical metals. Even though the price goes down, if the inventories continue to deplete, its time in the sun will come, and it's going to rip it. I think it's going to go nothing, 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 and then a whole bunch of everything. Because the physical market will take over at that point, and I don't think that the paper market's going to be following anymore. I think we're going to see a big divergence. From what I understand, the physical market's getting pretty tight. At least that's what I hear from Andy Scheckman and some of these other guys, is that the physical market's getting pretty tight, and that they're starting to limit order sizes from the big picture view from the big distributors. And you know what? I mean, that's probably the first sign, and then we'll see what happens after that. So I'm not one to sit there and panic, but I've already kind of prepped for this. But it's I don't know. I'm going to pick up more physical metals for myself, make sure I keep them coming in, and that if they're unavailable at one point, then I'm ready for it, I guess. At least hopefully that's how I think about it. But if you guys need help with this upcoming bull market, I've got some really good picks in the energy service sector, energy exploration production, some good leverage plays. Uranium, I think I've got the uranium market, at least the companies I think I've got pretty well understood for this bull market. I feel pretty good about a lot of the companies that I'm invested in, the ones I've overweighted, the reasoning behind it, the CEOs. I mean, I've dug in a pretty good amount in each of these companies. I think the charts look really good. I know which ones are the most leveraged, which ones are the least leveraged. And if you want to fast track all that research, you can sign up to the Platinum membership on finding-value.com. And that's where you could just skip the whole thing. I've got a lot of information on there in terms of pounds, I should say dollars per pound. And some of these, I've got some of my favorite companies on there and the presentations that they have and some video webcasts and stuff. So I think we've got it pretty well covered in terms of companies. And that's the biggest thing, is getting the big picture right. And I think we got the big picture right. And then getting the companies. I've spent a lot of time on both. And that's what you need to do. You got to get the big picture right. Get know where the value's at, know where the money's flowing, and then get the good vehicles to make good use of it. I think we're pretty much, at least from my perspective, I think I've got it covered pretty well. And I'm pretty happy and excited about the portfolio and what it's going to do if uranium and oil were to take off here at any second. So pretty happy with it. If feel pretty content. But if you guys like the content, give me a thumbs up, subscribe to the channel if you haven't already, and we'll catch you next time. This is Finding Value.